Well, first up, we're talking to Peter Brook and Warren. We've been looking at the Old Mutual Flexible Fund. Peter, give us your thoughts right now. You've obviously got 50% exposure to the South African equity environment. A number of people out there saying South African equities are looking relatively expensive. I suppose it's about your sectoral bias at the end of the day in terms of whether you deem the market to be expensive or not.
Well, it's a nice day to have some shares with the taper later trade coming through. But I tend to look at it in total equity exposure, and the fund's got just over 70% at the moment. Now, this is an aggressive fund that can go up to 100%. On the low end, it can go down to 0, but the lowest it's actually ever been down to is around 50. So I would say that level of 70 is indicating a bit of caution about equity markets. And so I think the point around valuations is well made, but much more in South Africa than overseas. We're at the maximum we can be in terms of international equity, but local equity we're a bit more cautious.
So, Peter,
I think
just
in
to
terms of those
interject
valuations, there's a couple of interesting things to look at.
Just to interject, I want to break it down for our audience in that absolutely, as you say, your equity exposure is somewhat over 70%, and that is South African equities at 50.4%, your international equity, as you say, almost at your maximum allocation of 25%, sitting currently at 23.5%. And I interrupted your train of thought, so you can take it back again.
Cool. When we look at the South African equity market, we've really got a hybrid market at the moment where resources have underperformed very badly and look cheap on the face of it, but that is very much dependent on what happens to commodity prices. On the other side, we've got the financial and industrial shares which have done very well and are looking pretty expensive compared to their own history and also relative to other emerging markets and also developed markets. One of the interesting things we did, I was looking at just the other day, was the dividend yield on our market looks all right, but you've got to remember that the dividend cover has dropped to 2 times. Now, very simply, what that means is you've got 100 of earnings, you're paying out 50 cents as dividends, and 50 cents is being retained. And we used to retain 60 cents, so that reduction in the amount that we retain reduces the future growth potential of our market. And so when we do very long-term analysis in terms of expected returns on the JSE, and I think that's just an important thing for people to think about, is that the future potential growth from our market is not going to be quite as good.
Peter, that's a fascinating stat that you raised there, and I wanted to get your insight as to why you think South African corporates are paying out more dividends and retaining less.
I think it could be it's really a function of what their available investment universe is. Back in a decade ago, 15 years ago, there's a lot more opportunity to invest. So take the retailers as an example. They were doing big store rollouts, the emerging consumer. Now the environment is not quite as attractive. There's a little bit less opportunity. I think another factor, and this is really getting quite technical now, is back then it was the go-go tech bubble, the 90s, so you had very high growth rates, and it was all about growth. And I think the focus is moving more towards dividends, and quite frankly, I think that's right. At the end of the day, you're buying great companies to get their dividends and to enable some growth in those dividends. But dividend is a very important part of your total return.
I want to come back to the comment you made on the resource side of things and get your view on where you think resources in the South African context are ultimately headed. Obviously, a lot of the discussions that we have on this desk put resources are married to the China outlook and what we see on that front, and we'll continue to see the resource share prices buffered by any economic news flow out of China. Peter, your thoughts?
Look, obviously China is a huge factor, but I think the long secular trend in resources was from a very low level, and you had the resource super cycle, and South Africa, and actually the whole of Africa, benefited from that hugely. And with China changing to more consumption-led instead of investment-led, that is a bit of a headwind for them. But also, for the first time, we're really starting to see supply coming through. In the second half of this year, we're going to see a really big supply of iron ore coming through from the likes of Rio Tinto, BHP Billiton, and it just changes the fundamental dynamics. So I think the days of very high commodity prices are largely over. It's going to be around how do those companies deliver. It's going to be much more stock specific. And going back to the point I made earlier about dividends, the key thing from these companies is going to be, do they produce the cash flow? Do they pay out those dividends? And I think that's really what the market is looking for, is more of that and less of digging holes in the ground and throwing more money in terms of capex. And we're starting to hear the right signals from the mining companies around that.
Peter, I just wanted to get your...
I think in terms of my positioning in that fund, we've got a bit of... Yeah, carry on.
Yeah, sorry, Peter. I just wanted to get your impressions before we break down your portfolio construction. I missed Bernanke's comments last night. I just wanted to get your takeaway from what he said. And I wanted to, I've got an idea that one of the signals we'll really get that the world's recovering from the global financial crisis is when investors don't pay as much attention to Ben Bernanke as they are at the moment. I wanted to see what you thought about that.
Okay, so I think in terms of the Bernanke news and the market reaction, it's my colleague Alida Jourdan made the statement, it's taper later. So the market moved on to the tapering trade, and now it's just been pushed out, and that allows a relief rally. Really, if you look at it in a longer term perspective, and that's very much what we do, is you're coming from the Great Recession, which then became the Great Repression, where interest rates were pushed down to artificial levels, completely unrealistic real bond yields, and quantitative easing capping the returns that people could get. And essentially that's a tax. That's stealing your money through negative real interest rates. And now we're starting to talk for the first time about the Great Rotation. Do we come out of that? Does growth improve? And therefore monetary policy becomes less relevant and the focus is more onto growth. And I think we're on the very early days of that. And really, the market got a bit ahead of itself. If you look at the sharpness in the move in global bond yields, and as a result of that, the very sharp sell-off in South African bonds, emerging markets, a number of different factors, it was probably too much too quickly. And what Bernanke has done is just reminded people of, yes, quantitative easing will come off, but it's going to take time. And with that, you can get a bit of the Great Repression trade coming back on, which is good for emerging markets, it's good for resources, it leads to a weaker dollar, and a lot of those trades are coming through at the moment.
Peter, I just wanted to bring that back into your portfolio and ask you then, where do you really find the value at this point? You obviously spread the assets across the world. Is your emerging market equities still the place to be, or are you finding more value in the developed markets?
Well, in terms of this trade-off between the Great Repression and the Great Rotation, in the Great Repression, you want to be positioned with as little cash as possible. In the Great Rotation, you want to have as little bonds as possible. So the flexible fund at the moment, it's got a small bond exposure, but very negligible. And it's primarily focused on equities. And as growth comes through and interest rates rise, I think it favors equity, and particularly in terms of offshore equity. And within that, I think it's not so much developed versus emerging. I think you're going to see a lot more dispersion between different markets and different areas. But I think what you should see is a more cyclical bias towards markets. And these very expensive defensives, the consumer staples which have been bid up to very high multiples, I think will battle to go forward. And you're going to see a little bit more of a value orientation, a little bit more of a cyclical orientation. In terms of the way we've positioned our funds, within it we've invested in Barrow Hanley, one of our sister companies overseas, who's an excellent global value manager and they are positioned in those early cyclicals, your autos, that kind of area, and I think there's a lot of opportunity in that space.
Just looking at your top holding, Peter, being MTN, sitting at 4.1%. MTN obviously is what many people would term a growth stock. Is that positioning going to change with MTN trading where it is at the moment?
If you look at all of the top 10 holdings, pretty much all of them, one of the key factors within them is that they have major international exposure. And in terms of growth, valuation, opportunity, we see more opportunity outside of South Africa than inside South Africa. So there's a lot of companies. You've got Richemont, Naspers, BHP Billiton,
Bidvest,
MTN,
SAB,
even Old Mutual, Investec, which have got assets overseas. Exactly. All of them have got international assets. So that's the positioning there. In terms of MTN itself, we have actually lightened a little bit. We had an even bigger position. It's done rather well for us more recently. And the story there was very simply one of you're getting good yield. So you've got the valuation story, but you've also got growth. You've got exposure to the Africa story, and you've got some currency benefits coming through.